Bala sir, good evening. Can you hear us?
Yeah, I can hear you. I can hear you. How are you?
Very good, very good.
Good to see in the screen.
Good to see you.
Instead of the course.
Good to see you too. So, thank you, Bala sir, for consenting to join what we call the Insights Exchange by Altifi, and thank you for giving us your time. But for our viewers, I must introduce who I call Bala sir, or very fondly known as Bala sir. So, Mr. Balasubramanian is the Managing Director and CEO of Aditya Birla AMC, a stalwart in the mutual fund industry, manages over 4.5 lakh crores of assets today. Bala sir has been with Birla for the last 3 decades plus and counting, right, Bala sir?
Yes, I'm counting.
And most importantly, Mr. Bala sir was the chairman of AMFI. If today we hear mutual fund sahi hai across the world, it is because of it was done in your chairmanship.
Chairman, yeah, correct.
Which has changed the mutual fund industry completely. So, and of course, Bala sir has been named CEO of the Year from Asia Asset Managers. He's also alumni of IIM and Harvard. And of course, Bala sir is also doing a lot of charity work. So, Bala sir, thank you. Really, really pleasure to host you. And thank you for consenting to join us.
It's my pleasure, Priyashis. Of course, our interaction always used to be quite regular in DBS, and the new avatar, part of Nathan Arc, I'm happy to be part of your association, continuing the association with you and the team.
Oh,
and you mentioned about mutual funds. Of course, it's a teamwork. So I was happened to be chairman of the AMFI board that time, and with the team of, there's the one beauty of our industry is to collaborate together in order to build the size.
Absolutely.
So that's what we put out, and of course, now it's become the power of Indian capital market.
Absolutely right. No, good to learn from you, and I'm sure a lot of our investors would love to hear from you and your rich experience in this world. So I'll jump to my first question, and there's a lot of noise with the current prevailing situation. So a lot of our investors would be confused what to track. Is it do we track the inflation? Do we track the oil prices? Do we track the US rates, the INR stability? What is it? And now there's a subsidy also which has been announced. So what do the investors track? What is key for them?
I think, ideally speaking, we should take the burden from investors. And of course, later on I'm saying. So I think the more I'm dealing with the capital market, energy price generally is something has got its own impact. I think the current uncertainty and the global geopolitical uncertainty, and led to that is the oil prices. Generally, fuel prices has got an impact not just only on you and me as a consumer. It also is an impact on the user industry, such as oil industry. It has an impact on fertilizer industries and so on and so forth. Fortunately, in India's case, last 4 5 years, there is high concentrated effort, both from the government as well as from the Reserve Bank of India, to keep the inflation under control. And second is, government also most of the time does not pass on the loss to the consumers every time, unlike US. I think most of the other economies, whatever the increase in cost that comes to the consumers directly. Most of the developed economies, India is one unique where we don't pass on all the burden to the consumers, therefore it doesn't reflect on the inflation per se. So this is something normally happens. Therefore, while we have various moving parts are there, like fiscal slippage is one, inflation is one, and the oil price is led, the fuel led inflation is another. Current account deficit we normally track, bank of balance of payment we track, which is linked to the currency movement. But all those moving parts ultimately, Government of India and Reserve Bank of India and other regulators, when they track it, they take measures which would actually reduce the impact of all those things from a broader economic growth point of view. At the end of the day, single point agenda for us is actually GDP growth. I think that's a single point agenda at any cost of time. Even recently, a question was asked to Prime Minister in a closed door. One of the journalists was mentioning to me, and you are on which side of the country? Is Israel or Iran or GCC or US or Russia? And apparently, he gave a very smart answer saying, "I am with Bharat, India." So basically, the focus on India growth, and that's a very clear when that such a clear understanding is there. And these moving parts, while the impact of these moving parts could be multifold, that's something the regulator takes that call and taking measures and ensure that that doesn't create damage as it stands today. But having said that, the current challenging environment, which is oil price going to about $90-$95, it has an impact on India. There is absolutely no issues. I'm only saying how we are different this time versus the earlier times. When the oil price touched $140 before, then Goldman Sachs came with a prediction it can touch $200 and never crossed $140 after that. I think it started falling. I think since then, alternative energy has become the main source of focus for most of the countries, including India. And India has won progress quite a lot in building alternate energy, which is a mix of today between fossil fuel versus renewable energy versus nuclear energy. If you take, I think the mix is pretty decent. In the sense we have traveled quite a lot. And coal-based thermal power plant post Russia war, people have actually left behind the ESG focus. So now coal-based energy supplies also in India is quite high. Therefore, I would normally say while these parameters we have to track it, but I think we also have mechanism to actually fight these changes in order to ensure it doesn't come and harm them as much as we fear on them.
You're absolutely right. In fact, we just went live with the breeder reactor, right? The first breeder reactor in India. So the alternate source of energies are coming through. So coming to, therefore, you talked about inflation. So do you think with the current oil prices where they are, energy prices, and you said they do determine the common man's goods, do you think there will be an impact on rate hikes? Because the MPC did not suggest anything.
So, in fact, at least I've been privy to the pre-policy discussion, which RBI governor does with market set of people. So, I've been one of the person also been attending this. I think clearly, I would say we are in a comfortable position as far as the inflation concern. When I mean inflation concern, last 4-5 years of focus on low inflation definitely has made RBI to cut interest rates, and therefore there is no incremental interest rate cut can be expected. At the same time, inflation has always got room to go up. The sense currently about 1.5%, 2% inflation. We can go up to about 4.5% kind of inflation. Absolutely no problem on that. They think even till about 4.5%, there is absolutely no need for RBI to increase the interest rates. From a cut to hike, absolutely no need at this point of time. And second is on the inflation side, the government fuel-based inflation, especially the pump prices, I'm saying, which is the petrol pump prices, unlike US or maybe GCC countries, and here pump prices more or less remaining the same. That is because of our pump prices are calculated basis the earlier oil price which is regimed about $95. That is where they fix the price. After the oil price, we saw it coming down 65, now it's back to 95. Therefore, there will not be need to actually increase the pump prices at this point of time. Even post-election, there will not be need to do that. Therefore, impact of that fuel-led inflation could be marginal. But where the inflation would come is the input industries, basically the oil being an input industry as a raw material, whether it is on autos, whether it is on the airline industries, they all have to actually pass on the cost of rising cost to the consumer. Therefore, it can lead to some inflation coming back. But still, even if the inflation coming back, going to the construct of the portfolio, till such time we don't see the food inflation going up, which is the case at this point of time. Inflation largely will be under control. From a rate hike point of view, I think as long as we are more in the tolerance level of about 4 to 5%, rate hike may not be necessary. But rate hike can potentially come in 26, 27 upon the other countries, our growth rate has to come back. I think for us, if the growth rate comes back to about 7.5%, then you will probably see the rate hike. Otherwise, I would say the current policy rates may remain for a little prolonged period, at least for this year full.
Very interesting to know. That's a good, interesting view because you broke it down, saying that if the food inflation is not impacted, you would see a tolerance level which is higher than 4% going up to 5%. So that leads me to the next question. So I would say the financial stocks will therefore, I mean, while the input prices might go up for the oil-related industries, but the financial stocks and the financial services industry in terms of banks will largely be unimpacted as of now in terms of both credit growth and NIMs. Will that be a fair statement to make?
Yes, financial industries might be, it should do well for 2-3 reasons. One, the cost of borrowing is still relatively lower. Because the Reserve Bank of India has been providing liquidity. They have ensured the industry should not, the system should not start with the cash insufficiency. Therefore, that remains. And second is RBI ability to provide long-term financing for banks in order to fund the growth. I think second is they have enough room. They are doing it already. And third is they have been actually removing some of the tightening that they did when the financial industry was growing about 40% lending growth when it was coming. They took a lot of measures to tighten the various risk metrics, and now they actually relaxed it. And I presume the clear focus for growth to maintain, for the GDP growth to maintain, they will also encourage more lending to be done from the broader economic growth point of view. So therefore, financial industry should become one of the benefits. Second is the current, the environment, what you mentioned about interest rate hike. Rather than interest rate hike, the lending rate can marginally go up. I think lending rate marginally go up, it also lead to an increase in NIM for the financial industry, which also could be one of the value driver from the broader perspective. Not, of course, coming at the cost of borrower getting impacted. Maybe a 50 basis point increase in cost is not going to make anyone suffer in the broader borrowing side of the market. Therefore, broadly, I would say from a banks and financial point of view, the credit growth will remain a key area of focus, which is what I think is picking up, and that something will also come probably at the cost of margin increase in rates on the lending side. If my borrowing cost goes up, I have to pass it on to the consumers, which I think financial industry generally does it nicely. At the same time, they also have backup facility to borrow cheap from the bank company. They will also lead to, in some sense, NIMs actually getting or maintain or getting better. So this is what I see as far as the financial stock concerns. I think they remain as a core integral part of the industry. In fact, I have seen cycles in the market. Generally, the NBFC references would come for a variety of reasons, sometimes for good reasons, sometimes bad reasons. But this is a time where this year, clearly, there is a clear acknowledgement has come from the Reserve Bank of India. The role NBFCs plays in the economic growth. Right. Finance Minister has acknowledged that the role of NBFCs in the financial market, and therefore, reasonably good amount of focus will continue to remain to ensure the financial industries remain one of the driver of the industries, given the fact that they are completely insulated from the potential risk that otherwise used to be earlier fearful. Now is no more exit, I would say, at this point of time.
Lovely. Let me change the topic a bit. Now we know that many states are going to go through elections. Some have happened, some will go through. What is your view on, will that pan out in the markets in some way? Is there a reinforcement of stability? What is your view on these states, especially two key states?
I think I'm just putting a different thing. Both the states, they have to make an inroad. I think the ruling government in the center has to actually make an inroad. So they are making all the attempts for the last 2-3 election time. And it's not that easy market to break. But assuming they get better vote share, which is one possibility. And second is whether they come with the complete majority. There are certain markets where people are actually predicting. There are certain set of people who are predictions are saying that nobody can replace the existing government, therefore they will come back. Whichever way you look at from a market point of view, I would say is neutral, given the fact that at the central level, they are still very strong and they don't need anybody's support to the extent not an issue. Second is whether they run the state or don't run the state. Fortunately, central government does not differentiate, saying we are not ruling, therefore we will not give any development activities. Development activities become common everywhere. So whoever comes can only take the account to the next level. So one of the areas which I have some kind of assumption, Uttar Pradesh, when the BJP won the government for last 2 terms, BJP's contribution is almost close to about $1 trillion kind of, we are going towards $1 trillion economy.
Right.
UP alone. That's why I think they are moving. The next comes is the Bihar. So now Bihar this time they are completely focused on development. Gujarat continues to fire. If you take Maharashtra, now they are spending so much in making Maharashtra to become the largest contributor. They are also marching towards $1 trillion economy. So if this state also comes, they can actually contribute to the overall economic growth. Therefore, if they come back, the contribution to the overall economic could be quite high. If it doesn't, we'll still be growing at about 6.9 to 7%. That's why I see it. But I think very difficult to predict the election outcome on both the things. I think these states are extremely tough states to predict as to who could win, beating the existing players. That's something we do not know. But either side, if it comes, they come back, if the BJP comes back, definitely it can add to the another 23 basis point extra growth for the GDP. If they don't come back, rest of the states has to contribute to the largest success. And what they're running currently, they will be able to continue to run the way they have been running it. Therefore, it will not do any harm, I would say. But if the state comes back, I think it can, on the overall picture point of view, even the worldwide would start looking at India, but more differently. Therefore, association with India could go up quite significantly as one of the leading nations in the world. These are some of the benefits that could accrue. But that's something anyway we'll know in another 3-4 weeks.
Yeah. No, but it's a good point you raised that it is the markets are neutral because then the development is not state-based, there's no bias. And the fact that if we get an upside, it's even better. No,
Correct.
Lovely viewpoints. So coming back to a little bit of a sectoral view, and especially because we operate in these 3 sectors. So what's your view on the India MSME, consumer finance, and the rural finance sectors, given the current geopolitical stress? You obviously underscored the fact that food inflation is not a problem because the oil prices are pegged at 95. But in these 3 sectors, what are the bright spots that you see?
I think SMEs and the small scale enterprises across the country, I think post-COVID, they got a huge recognition thanks to the government of India giving a guarantee for the loan that they have taken. In fact, most of the lenders, this is one of my common understanding, the theme that I have, is most of the lenders who used to think SMEs and MSMEs are risky assets. And in fact, post-COVID, they are proved wrong. And most of them actually, when they started lending to them, thanks to the government of India guarantee, they could get a better sense of how MSMEs and SMEs actually in the country can equally a potential good borrower with the repayment guarantee almost coming to about say 100%. I think the default ratios in this segment is also equally less. Therefore, this segment will remain one of the fastest growing, rather large consumer of the borrowing from banks, NBFCs, including your firms and the banking system. That's one. And second is the number of companies who have been operating in the SME space, and post giving this benefit of making manufacturing. Just give an example, railways. While railway is spending, there are almost about 280 to 300 small scale enterprises are the one working closely with railway related activities. It could be as small as a canteen run company and nut and bolts kind of manufacturer, and go up to the high end hydraulic kind of engineering activities they're doing. That the pie is growing. Likewise, if you take each of these sectors, whether it's road-related infrastructure, small size companies, regional players, that something is growing. I think one of the bigger strength and advantage that we have as a country, the large pool of almost about 3 lakh 40,000 companies are registered as per the Ministry of Corporate Affairs. So all of them actually are the contributor to the success of Indian economy. I think that will remain as one of the key. Even the Reserve Bank of India has been keeping a very close eye how the SME companies can actually get an access to the borrowing from banks. And that's something, it comes through Mundra, it comes through SIBI, it comes through NABARD. These are the institutions that provide refinancing. In fact, to my surprise, like the institutions such as Mundra, institution like SIBI, that book has actually doubled in this year as well, almost about 8 lakh crore kind of a book, both for lending as well as refinancing, which essentially means these institutions, which are, I call it as the intermediate institutions, who is supposed to be helping the whole industry, their book size is growing. Their book, like PFC, REC, they all fund the large pool of companies across the country. And that's something as the book size is growing, which essentially means this will eventually lead to SMEs to become one of the driver. That's why I think most of the NBFCs today, the big area of focus is there. But I don't see any kind of the current scenario. It doesn't anywhere look like any risk is lying. Risk is actually is there. But of course, potential risk could come. I'm not saying no. But it doesn't seem to be that much scary, given the fact their own track record with the banking industry dealing with the last 6-7 years is far superior. And finally, Reserve Bank of India also looked the sector more favorably and provided timely support, which also would come if the situation arises.
Thank you. Let me come to a very let me come to mutual funds here. So now, how do you see the SIP flows in the current crisis? Number one. Number two, can it be a full offset for the FPI outflows? You've seen almost 60,000 crores going off. So what's your view, given that you created this mutual fund which has all led to all of us investing, I think.
Right.
So what's your view on the outflows and the offset from the domestic flows?
Yeah, I got domestic flows concerned, Priyashis will continue. Even March also the month, I would say one of the worst months from a news flows point of view, volatility of the equity market point of view. The still industry got about 32,000 crores of monthly inflows this year too. Therefore, in my view, this trend will continue. Second is the narrative of falling market to invest. That normally applicable for the investors who have been sitting on the fence. The investors sitting on the fence continues to remain large. And third is other instruments, if you have to look at it, whether deposits or bonds, they're not as attractive enough for investors to shift back to the traditional savings such as fixed deposit. Therefore, saving through the mutual fund SIPs will remain as one of the instruments, which is what the power of mutual funds education and financial literacy have done. So I see a lot more maturity investors as it stands today. Therefore, domestic flows will always remain. In fact, even FOM statement in the parliament arguing with Shashi Tharoor that retail investors have been the savior of Indian capital market. So let us not get worried about FIS flows. So that's a statement which came. So to the extent, I think my view is real, it will continue. As far as the FIS outflows concerns, I think their margin, their outflows were of 2-3 kinds. One, Indian markets were becoming too costly last 2-3 years. Right now, it's come to the buying level. Whereas 2-3 years of FIs, I still remember we had one large investor who moved out almost about 8 months back. That time, though, I was pushing them, actually, they should not redeem. But when I look back, that decision was right. Because they removed because of high valuation. Second is nominal GDP in India was less than 9%. That means your earnings growth cannot be more than, say, 10-12%. And valuation of the PE multiples high. And then third is China and other markets were actually relatively looking better than India. Therefore, foreign investors have got choices. So therefore, they were actually allocating money to the other market. MSCI India weight has also for India has come down. My belief is this year, the having sold continuously last 2-3 years, there is high probability we can expect a reversal on two reasons. One, of course, rupee dollar finally corrected. It's about went up to 95. Earlier it was about hovering around 84, 85. So people would have assumed this is a good time to exit. Other rupee will depreciate. Therefore, people have preempted that. Therefore, I would assume with the 93, 92, 93 and having touched 95 and sterling 7, 90, 93, people may see actually from here onwards, we could see a rally coming in. And therefore, you come in. Second is, despite all the issues, balance of payment is at the brink, is still, we are better than most of the global countries. Therefore, and market valuation, both I think will make FIs to start thinking allocation towards India. So I would assume this year allocation towards emerging market may go for a reshuffling, in which I think India could some kind of inflows. Even if it comes about 2,000 crores, 4,000 crores per day, that itself will be enough to reignite the confidence on the market to come back. So that's something I just say. I think before FIs coming in, I would probably assume FDI flows can pick up. For example, as I speak, two FDI flows came in the month of March. There is one for Bhushan Steel. They have got a joint venture. FDI investment came. The second is Shriram Transport. They got their Mitsubishi, that money which came in. That's again FDI investment. I would probably see in the year 26-27, the rest of the year, you will see FIs, FDI flows coming into the data centers. I think this current crisis has also created uncertainty not only on GCC countries, also created uncertainty within Europe and US for the large data centers kind of setup. Therefore, there is a high probability that the FDI flows could come in the data center, where the government of India has given tax-free status for 20 years if they set it up before 27. Therefore, I see FDI flows also improving. So the moment they see that rupee will stabilize, will start appreciating, my way FIs flows will reverse. Not that they don't have, of course, they have been, since the time the US yields started going up to 4.4, 4.5, and there was no rate cut in US was on the card. The expectations are there, but nothing was coming. So variety of these reasons, they have gone back developed market and emerging market. But there is a high probability this year you'll see the FI flows getting reversed.
Lovely. So and tell us something about your view on gold. So as an asset class now, is that safe haven, uncertainty still prevails? What is your view on gold as an asset class?
I think gold will remain an asset class to own. We are doing an uncertain period. We can't say uncertainty now completely is over. It is a begin with the aggression. Maybe the aggression may get over. Probably I would say uncertainty may remain because geopolitical risk has now become a real risk. So therefore, to the extent gold will also act as a hedge against some of the risk. Therefore, I would say gold could remain as one of the asset class with the reasonably firm in terms of price movement. But I would say the significant run that came last year, gold was the best asset class among all the asset class. Silver was a super duper. But that, I think, exponential trend that we got last 1.5 years, that I think will go the way equity have seen the last 2-year correction. When gold may go through the period, but still is one of the asset classes which cannot be ignored more from the safety point of view, hedging point of view. And that led buying will remain in gold. And sovereign funds who have been a large driver of the gold prices, they may not actually be the driver of the gold prices as Turkey came and sold gold. So these are some of the things which also come in the case of gold asset class. Therefore, while remain as asset class to be owned, but must also be aware that it cannot give expecting high return. But the ownership is a must from gold, more from asset gain point of view. Silver is something has run up quite a lot. It's industrial metal. It's run up quite a lot, and we have seen already the pressure on silver. Therefore, silver is an asset class. Even if you don't own it, I don't think it's something will be at loss.
Understood. So, Balasubramanian, you also run a vibrant AIF and a PMS business apart from mutual funds. Now, how is that shaping up in the current space, and what is your focus in the AIF PMS? Are you launching any new funds? Is there anything which has been planned? in this space. And of course, the other question is, I think as a SIF as a category, you've not launched yet. So any
We have launched.
We just launched.
Yes, launched. See, as far as the SIF concern, Priyashis, is a new animal. It's something we'll have to try it out. So we're also creating our presence. We started a little late because we didn't have a talent who were capable of running this portfolio. So we took some time. We didn't take a lead in the space. We thought we'll follow somebody. So that's why we have taken that call. And now we have built up the team with expertise. But again, we'll have to give some time for the fund managers to be tested in this space. From an investor's point of view, it can be good diversifications, but not investing, I would say you are nothing is going to lose or something immediately. It's more for allocation purpose we can consider. Maybe we can still give a time before allocate large pool of money in the space. As far as the PMS concern, I think the fund house been quite bullish on individual portfolio can be managed with the PMS things, and we are running small sector opportunity portfolio, where it's given reasonably good outperformance of about 6-7% to the index. Even the negative it is given outperformance to the index actually. That's something we are doing it because ultimately Indian market will remain a stock picker market. Small and mid cap market will remain large market to pick stocks, and therefore PMS we felt that there is a space for this to be there, and we as a fund house created presence. The other area where we are building our asset is on the AI performing credit as well as the AIF real estate credit. These two segments needs money, M&A financing, promoter financing, or leverage buyouts, and family dispute when happen, not family dispute, when family getting split and companies are getting split, they need funding temporarily. It's like ESOP. I may have an ESOP, you may have an ESOP, you got to access the ESOP, you need somebody to fund. And the same way, even for corporate promoters, the funding needs to be done. The private credit market is something is pretty big, and India is growing. Of course, US private credit market is going through their own tough time. But I think India is just beginning in this space. That's something we are not done. Second is private credit market on the real estate side. I think real estate actually the one sector has actually become one of the organized sectors in the last 6-7 years, thanks to RERA. Plus post-COVID, after a period of brief dull period, real estate market across the country has picked up, but they need financing. And that need financing, working capital financing, they need investment financing, they need financing after the buyout the land to the extent of 90%. For the rest of the period, they need financing. I think we as the fund house created real estate AIF fund catering to these needs of segment in terms of lending. From investors' point of view, we look at generating close to about 14 to 15% kind of return, which is pretty decent. We don't take the high risk of, there will be enough people who are willing to borrow 20 to 25%, but we will not get in the space, given the fact higher the interest rates, you get, higher the risk that they carry. So we don't want to get in that space, but in the range of about 14 to 16% kind of range, we are working on it. So as a fund house, we raised about 700 crores in the AIF performance credit last year, and the real estate fund, we currently run a portfolio about 900 crores, and we want to build this size to the next level, given the fact that this relatively real estate credit market is actually really safer asset class to get in. It has at least good coverage in terms of cover, I'm saying, in terms of protection, in terms of security. It's pretty decent for us to take the risk in the space there.
Lovely. So I will now open up the house for questions, Balasubramanian, because I'm sure a lot of people will have questions. So we'll just check on the questions that we have, and I will try to ask you the viewer questions. As an individual trying to make better financial decisions, what is one signal or trend from today's discussion I should actually keep track over the next year?
I think the development, the current progress that we are making in terms of the ceasefire things, as it becomes more better, I think oil price could still somewhere around $75 kind of things. The moment that happens, I think the whole negativity I think will disappear. So this is something is the only one where we have to keep a close track, and to change your views. My own belief is it will happen. This is something one has to keep in mind. And second is, of course, as I mentioned earlier, valuation is cheap at this point of time. Now, I'll not say cheap, but it's at a reasonable level. it's below the long-term average. That also, in my view, cannot be ignored while taking the investment decisions assistance. Sometimes the question which comes, should I invest, should I not invest? Therefore, I would probably say the best time to invest actually when the valuation is nobody discusses the valuation, and then when it becomes cheap, nobody discusses it. When it goes up high, we discuss high valuation. And today, valuation has come to reasonable level, nobody is discussing about it. Therefore, that's the best time to invest. My margin of safety is higher.
Understood. Understood. That gives a good segue to the next question, actually, somebody's asked. After everything we've discussed, are you more optimistic or cautious about India over the next 12 months? And what is the biggest reason?
Yeah. So I would not say cautious. I would probably say optimistic for one reason. Whenever we are pushed to the corner, I'm saying, when we are to worldwide, I'm saying, we quickly turn around and start looking at various other things that we have to do in order to ensure that we remain resilient to the current crisis. Of course, we'll get impact, no doubt. But can we take few other steps at the same time, which I think I'll give you 1 or 2 examples, like petrochemical space, and oil discoveries. The huge amount of investment now is being made, which was not the case earlier. This is only capex, right? Earlier, we always think we have allocation of 12 lakh crores, which segment can take the large pool of money. There is no sector where we can spend money. So now suddenly this sector has come in terms of where they can spend money. That's something which is there. Second is on the coal. We have a large pool of coal belt in India. And last few years, our consumption of coal to the extent would have been less for a variety of reasons. Now, coal-based investment, including discovery of gas, which can feed to the industrial sectors. So the government actually is spending now more money, and they're only doing a viability funding for some of these projects, so that whoever actually take a leap of faith bet does not need to suffer. Therefore, you don't discourage private capex to come into the space. So that's something is also being done. Therefore, all the things plus valuation. Valuation is something, if I take, like some of the banks are available at 1.8 time price to book. Is it, can we say that it's right or wrong? But given the fact that all of them used to trade about 3.5 times price to book in the past, we must actually pay attention to that moment also. Therefore, I'm a bit optimistic only from that angle, more than cautious.
Oh, thank you for your view. Next question is, I'll read it out. If you had one piece of advice to give to young people, I don't know the definition of young, but assume below 30, below 35, depends on you, trying to navigate this uncertain economic environment, what would it be? I assume it's regarding investments.
Now, the young investors, I presume a lot of the young investors would have tried their luck on the investment side. And last 2-3 years, a lot of youngsters have been trying their luck, looking at investment, and that's something would make them feel sad. But I think we must encourage them to not to pay attention to the red in the portfolio. I think we must tell them it's making investment long term. I'll give my one son example. He had made some investment in US. He was very happy initially. Then he became very sad for 3-4 days. He says portfolio all is rent. What should I do? I don't know what should I do. He suddenly thought his earnings have disappeared. And with the market bouncing back last few days, he said, "No, my portfolio has come back." Just about $10,000 he invested. So I told him not to dabble with the market, but he had put in some mutual funds there. And now return has come back. So his narrative completely changed. That's the reality. So that's something I think youngsters have to keep this in mind and stay focused on what you are best. In the sense that if you're already focusing on building your career by way of joining some companies, and keep that focus from a shining point of view. And investment side, whatever investment that we are making, stay cool and calm. We are not investing for today or tomorrow, investing for next 30 years. I think they will be seeing Vikshit Bharat. Some of us may or may not see Vikshit Bharat. If they are the Vikshit Bharat people, I am not saying they are the baby boomer kind of things. They are the Vikshit Bharat generation. So they'll have a lot of optimism ahead of them, playing out quite nicely for India. Therefore, they must keep that in mind rather than getting worried about the current volatility.
No, absolutely right. Uh, I will ask you another question, which is, I think, similar to the first one that you answered, which is about cautiousness and optimism. Given the current uncertainty, how should one average investor think about balancing risk and opportunity over the next year?
Yeah. I think the balancing risk, of course, is, I would say, in terms of allocation. So last 2-3 years, a lot of things were happening by way of what you call chasing assets, like IPO were one of the asset allocations that you look at. Every IPO you participate in order to make you gain and so on and so forth. And there was an element of something asset allocation was missing. So I would say the best way to manage the risk on a portfolio is actually not to ignore fixed income component of the equity portfolio, I would say. And some allocation should be there in that space so that the overall portfolio, even if it get impacted, it actually gives you the comfort that my money is of course losing, but everything is not losing. That will come through the asset allocation. That's the only best way to do it. Unfortunately, mutual fund industries gives you the option today. If I take multi-asset allocation fund, it gives me the option of not miss out gold, not miss out silver, not to miss out equity, and so on and so forth, right? That takes care of some of the things. If I take balance advantage fund, even my own balance advantage fund, when the market was uncertain, we brought down our equity exposure to as low as about 48%. As I speak, we have taken to 68%. I'm already doing the risk management, risk on, risk off, risk on, risk off. I need to take risk on also. I need to also risk off. For investors' point of view, risk on, risk off is very difficult. The only way they can do it through the having exposure to equity, having exposure to balance as a category, having exposure to multi-assets, and having exposure to some portion of the fixed income. Fixed income, of course, taxation-wise could be not favorable, but however, it doesn't matter. Everything is not about taxing. Everything is about something is about protecting also.
Yeah.
Therefore, that is the way I would say managing risk is important. Some of the asset classes which can be promising for you, but looks glamorous, but not sure how much return will come. Even if you avoid it, I think it should be okay. See, sometimes what happens, we also get swayed by the momentum in the market. Sometimes, like unlisted space, a lot of people are making investment. But this current market for next 1 year, we will probably see IPO market is not as rosy as what you have seen in the last 2 years.
Right.
Those are the investments they can, even if you avoid, it should be okay. And nothing is going to get lost.
Lovely advice. Yeah. One last question from the audience. What is the one mistake investor is most likely to make in the current economics environment?
One mistake I would say, sitting on the sideline, thinking that this problem will remain for longer, therefore, I will not invest. I think the way I always see is, problem comes, it becomes worst, then everybody, the moment becomes scary, the way I think US is chickened out, everybody is chickening out. So that normally comes bringing normalcy. The next risk will come a little later. I'm not saying will come say after 3-4 years. Risk will come later, but by the time what will happen is market will move upon the hope. That's something I think one has to just keep in mind. Therefore, that's something one should not make the mistake of keeping this will remain for too long, and that because we are becoming a little more resilient to some of the stuff. That I would say a mistake one should not make. Second is the chasing return today, falling prey for some of these unlisted space, or falling prey for some of the high return assets. That also one should avoid mistake, I would say. And last but not the least is there are a lot of private offering comes at a very high rate of interest. In fact, more than mutual fund, more than equity market, but investors falling prey at this point of time, especially for promised high returns coming from larger ecosystem today and unauthorized. That may mistake. I think deal with the authorized regulated entities compared to non-regulated entities. This is something not many talk about it. The biggest advantage of mutual fund are NBFs like yourselves or regulated entity. We have a lot of fiduciary responsibility. I may give lesser returns, fine, but at least safety element is high. Whereas underlying entity, a lot of people get carried away nowadays, and especially in the deeper parts of the even Mumbai, this kind of cheating happens. I think one should not make the mistake of falling prey for this.
Always the plantation theory happens. No, you're right.
Correct.
The regulated products, asset allocation,
Correct.
being cognizant about risk and reward is something which
Correct.
is to
Why specifically I took this point, Priyashis, without naming anybody. I heard from very learned banker, HNI, made huge money both as a salary as well as stock options. Got swayed by some false promises somewhere. He lost about 35 crores of money.
Wow.
And it's called digital arrest. For 35 crores he lost. Actually, it's supposed to be the reasonably well read person. Maybe age could have been one factor. Or maybe a known person could have colored his mind and so on and so forth. When I heard this, I realized how can it happen? But then I realized it can happen actually if you slip your attention. So it can happen. Therefore, a fraction of a second it can happen. And nowadays, once the money goes on a click of a button, then getting it back is not that easy.
No,
So even
absolutely.
as yesterday's I saw something a similar kind and to the cyber fraud. Therefore, I would say everyone to be careful as far as cyber fraud concerns. I mean, we will say I'm careful, but when I heard even a person who's a high knowledge can get swayed, then who are we?
Yeah, you're right. And sticking to regulated products with fiduciary responsibilities like ours is the best. Is the best.
Is the best. Okay, I mean, make less return is fine. At least there will be some element of safety.
Absolutely.
Yeah.
Balasubramanian, thank you so very much for joining us. Thank you on behalf of Altifi by Northern Arc. Thank you on behalf of all our viewers who joined today. It was pleasure having you over, and we will come back to you and ask you again in 6 months' time how you see the markets. But every interaction with you has been very insightful. The kind of views that you carry, the optimism, the granular detail that you brought about. Thank you so much, sir. I think all of us have benefited.
Yeah. Thank you, Priyashis. It's my pleasure to be part of the discussion. I will continue to have more engagement on this space. Thank you.
Thank you, sir. Thank you to all our viewers for joining in. Bye-bye.